Hey, it's me. In this video, we are going to discuss what is volatility and how do you measure it. So let's get right into it. So the definition of volatility is the degree of variation in a stock's price over time. Now there are a few different ways that you can measure volatility. One of the most common ways to measure volatility is by using something called standard deviation. Standard deviation is a statistical measure that is used to quantify the amount of risk in an investment. It is the square root of the variance, and the variance is the average of the squared deviations from the mean. I don't know if you remember this from your statistics class, but essentially what it does is it looks at the average square deviation from the mean. It takes the square root of that, and that gives you the standard deviation. In finance, we use standard deviation to measure the volatility of a stock's return. So if you look at the returns of a stock over time, how much do they deviate from the average return? And then you take the square root of that, that gives you the standard deviation. Standard deviation is usually represented by the Greek letter sigma, and sigma is a very commonly used measure of volatility. There are other ways to measure volatility. Another one is called beta, and beta measures the volatility of a stock in relation to the volatility of the overall market. So if the market goes up 1%, how much does the stock go up or down? So beta is a measure of a stock's volatility in relation to the overall market. Beta is usually represented by the Greek letter beta, and that is also a measure of volatility. There are other measures as well, such as gamma and value at risk, which are also used to measure volatility. But for the purposes of this video, we are going to focus on standard deviation and beta as measures of volatility. Now, why do investors care about volatility? Well, generally speaking, investors care about two things. They care about the expected return of an investment, and they also care about the risk, or, more specifically, the volatility of that investment. So how much is this investment going to go up and down in price? The more volatile an investment is, the more risk it has. And generally speaking, investors want to get the highest expected return for the lowest amount of risk. That's what makes a good investment. Now there are some investors out there who are willing to take on more risk for the potential of higher returns, but that's a topic for another video. If you enjoyed this video and you learned something, make sure to hit the like button. Also, if you haven't done so already, subscribe and hit the notification bell so you don't miss out on any future videos. Thanks for watching.